Worried about leaving money in your limited company at the year end? Watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And one of the key questions that pops up a lot is this idea of that people worried, owners worried about leaving money in their limited company at the year end. Like, is it a good idea? My accountant's not told me to take any out, and all these kind of questions. I thought it'd be a great time just to touch on that in this video and kind of put your mind at rest about how this all works. So before I do, if you like these type of videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. So what's the deal? Is it a problem then to leave money in your limited company? The answer is absolutely not. Actually, it is a point to consider around tax planning, but not the one you might think. So I think there's this weird sort of myth that goes around. I've certainly, and I know the team have encountered it over the years, and that's where somebody will say, well, my friend's accountant says that she should take her money out before the year end. And actually, it's probably just been mistranslated, because if you imagine when you earn money, let's say in your limited company, you're earning money, you're taxed at the time of recording this video at a very low rate of 19%. So that's your tax bill. It's fixed based on your profits, whatever you've made in that year, 19% tax, adjusted for all the different rules. That's it. At that point, the line's drawn and you'll hand over your tax, probably about 9 months after the year end. Fine. Now that money's taxed and done, it's not going to cost you any extra tax from a corporation tax point of view to have it sitting there. You can just leave it, forever and a day, and it will never incur more corporation tax at this point in time. So there's no issue with leaving it in there. I'll talk about some of the practical things about cash balances in a minute, but I suppose the more tax planning question at the time is, should I be looking at what I'm drawing from the company, and is that the most tax efficient thing? Because that's where it will cost you money. And I don't mean it's going to cost you any extra money to leave it in. That's where the myth comes. It certainly will not cost you anything extra to leave it in. It's, are you missing an opportunity by taking some of it out? And that is a very personal discussion, but it's looking at things like, have I used my £2,000 dividend allowance that at the time of the recording is available to UK taxpayers each year? As if you're a shareholder, that's worth looking at. Most owners and directors of limited companies will be both the director and the shareholder, the person that owns it. And there's a dividend allowance to take some money out. There's a whole video on that, so check that out. But have you used that? If you're going towards 50,000 and most years, maybe next year you're looking at taking 60,000 out, is there any benefit to declaring some upfront dividend and paying some money out now before your sort of year end, or at least the personal tax year end, to save some money against your future bills? All these things that go on, but it's all a tax planning question. It's not a question of it's arbitrary going to cost you money just by leaving it in there. So from that sense, there are opportunities or missed opportunities if you're not on top of them, but from the company point of view, fine. The other thing is people, and we will have done another video on this, I'm sure, but people often say, oh, well, my accountant surely they should be phoning me and telling me to spend some money before the year end to save tax. And taking us, for example, we will contact our clients and tell them, by the way, your year end's coming up, and now would be a good time to renew some equipment, invest in stuff if you wanted to. But, and I would say this time and time again, spending money to save tax as purely a tax saving thing is never a good idea, because you're always going to spend vastly more than you're going to save, but it's a time to look at that. But that's not what this video is about. But again, it's the same idea. You're not costing yourself any money. It's just, is there an opportunity to, save tax? Because actually, if you did miss that opportunity, didn't buy your equipment just before the year end, you're not actually losing out, because you'll just buy it in the next year anyway. You're still going to get tax relief, it's just later down the line. So it isn't costing you any money, but it's all about affecting kind of your cash flow and just looking for those opportunities. Now, I did mention that there is this other thing to bear in mind about cash balances, and that's quite an unknown fact for a lot of people, that the banks aren't 100% safe. I think we all grow up thinking the banks are safe, it's cool, our money's fine. But actually, what happens if they weren't? Now, there is this thing called the FSCS, this scheme that protects your money. It's a government-backed scheme, up to £85,000 of cash per bank. So if you've got a relatively successful business and you've got a couple hundred thousand spread across accounts, in theory, you could potentially lose more than the first 85,000 under that scheme. So it might be worth considering whether you want to split it across other institutions. So you might want to go and get a new account with another bank to store some of your reserves in, or something like that. And also having other relationships with other banks can be helpful later down the line if you need lending or you want to explore certain things. Personally, I think it's quite nice to have a bit of a history with multiples. So do think about that as well. Well, hopefully that's given you a feel for the fact that you're not costing yourself a load of money by leaving the money in there, but it is a really big question around personal tax planning. Should I be looking at more dividends? And again, it's probably outside the scope of this video. I know we've done more on it, but there are opportunities there to be able to earmark some money as a dividend that you can draw later if you haven't quite got the cash, but you've got the money on paper, all these kind of things. But do know and have comfort you're not costing yourself anything by default by leaving that cash in there. Please do share this with anybody you think needs to know this knowledge. Like and subscribe, and I'll see you on the next one.